and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today I want to go through different entity structures. You would have heard them: trusts, companies, sole traders and partnerships. But what is the difference between them? Let's find out. There are two main deciding factors on why anyone would choose a specific structure for their business. They could be tax reasons, asset protection reasons, even legal liability reasons. I'll quickly go through sole traders and partnerships. First, as they're pretty straightforward. We can then further in the video look at some really fun stuff for companies and trusts. When it comes to sole traders, you are the business. This means that if something goes wrong, it's your insurance that needs to be used to rectify any issues with the clients, and you can personally be sued for any negligence in the work you performed, and you will be taxed on all the income that this business generates. This might sound like there's so many things that can go wrong, and if you do dodgy work, it honestly can really be bad. However, this is one of the biggest segments of the business world because it is super easy to set up. Just apply for an ABN and you're good to go. As long as you have sufficient insurance and the work is quality, there's nothing for you to worry about. In terms of tax, all income and expenses are transacted through you. So if the business had about $100,000 in revenue and $50,000 in expenses, you'd lodge it through your personal return, not a separate return. You hear online about all the US people saying how they don't take a salary and they reinvest into the business or whatever bullshit they say. I'm not sure how it works there, but here in Australia, using the income and expenses I just mentioned, you would personally be taxed as though you made that money and you had those deductions. Whether that money was kept in the business as capital for next year is irrelevant. Partnerships are similar to sole traders in that they have unlimited liability. However, they're made of at least two different entities. Why did I specify entities? That's because a partnership can be between two people. It can be between two companies or two trusts. An individual in a company, an individual in a trust. Unlimited combinations possible. But to sum up, a partnership involves two or more entities. Now, this partnership itself is not an entity. It's just a temporary union between two entities. When it comes to tax, the partnership itself needs to lodge its own tax return, after which the profits are then split accordingly to the partnership agreement to the constituents, who will then pay tax on this amount themselves. So using the same previous example, there's 50K in profits. So if one person is entitled to 40% and the other 60% of the profits, person 1 gets 20K added to their taxable income, person 2 gets 30K added to their taxable income, and they each pay tax at their respective marginal tax rate, whatever that may be. Now is where we're going to move on to the really fun stuff. I'm going to save companies for last because they're my personal favorite. And like when eating a meal, you always got to save the best part for last. Trusts are a little weird. There's probably a few videos worth of content I can make just talking about trusts. We'll just go into a few details and give you the lowdown. There are a few different types of trusts. You've got discretionary trust, unit trusts, special disability trusts, just to name a few. And they all act similarly, but also differently. I'm not going to talk about special disability trusts, but let me know in the comments below if it's something you'd like me to talk about, and I'll think about making a future video on that topic. Discretionary trusts are called discretionary. At least I like to think the reason they're called that is because they can use discretion as to who they distribute income to. The thing about trusts is that they need to distribute all income that the fund receives each financial year. If they don't, then they will be penalized by having that surplus income tax at the top marginal tax rate of 45%. Because that's a lot of money, many discretionary trusts will have something called a default beneficiary. This means if they forget accidentally to distribute any amount, it automatically goes to this one person. So hopefully, overall, they can pay less tax. Each trust will have something called a trustee. This can be an individual or company. You can't be the single beneficiary of a trust if that beneficiary is also the trustee. You could do it through a company. That's a bit of a workaround. But in general, you'll tend to have one or two trustees, and you'll have a lot of beneficiaries that you can distribute income to. Who you distribute to will need to be written into the trust deed itself, but generally for family trusts, as an example, it'll be your direct family. Any siblings and their spouses, parents, grandparents, aunts, uncles, cousins, other entities linked to the groups. So if you've got 20 trusts, you can distribute from one trust to another, and also any companies that you control too. Basically, you could theoretically distribute income to many people and use that as a way to minimize the amount of tax that your group would pay overall. One little hiccup or issue around distributing to a whole heap of people is that these people are actually entitled to spend their money however they want if they're being distributed income to. Section 100A of the Income Tax Assessment Act 97 is an anti-avoidance provision, and it goes into trust distributions, and basically it's fraud if your trust is saying that you're distributing to these people, but it's just done on paper and you're actually giving the money to someone else as a way to minimize tax. Unit trusts are a mix between companies and trusts. Like trusts, they need to distribute all the income they earn throughout the year. However, unlike trusts, they can't decide who gets what. A beneficiary would own a specific number of units in the trust, hence the name unit trust. Let's say the trust needs to distribute $100,000 of income. If there's 10 units in the trust, each unit is then entitled to $10,000 of that income. If you own 2 units, you're then entitled to $20,000 of that trust income for that year. Now, companies are my favorite entities. Firstly, they're treated as completely separate legal entities. So while a sole trader business, you and the business are essentially the exact same. With companies, they're completely separate. Unless the director of the company is doing something that they know is dodgy, if something happens to the company, they can't come after the directors. Assuming there's no fraud going on and the business just failed naturally, because sometimes they do. If the business owed money to creditors, they would be out of luck, unfortunately. They can't come after the director's personal assets, which would actually be possible with a sole trader. Companies are also taxed differently. A small business entity or base rate entity pays tax at a flat rate of 25%. If they made $100 in profit, that's $25 in tax. If it's $1 million profit, it's $250,000 in tax. It's a flat rate. Large companies have a higher tax rate at 30%. If you compare that to a sole trader, they get the benefit of having a personal tax-free threshold, like a standard employee would on PAYG. However, eventually, their marginal tax rate would be over 30% of a company's when profit exceeds around about $200,000 a year. My favorite part about companies is that they are able to keep profits within company. Let's say they make $1 million profit. If it was a sole trader, that person would have to pay tax as though they made $1 million in income. The business might then need $500,000 reinvested in order to maintain operations. So after tax, they're really not left with a whole lot. With a company, they pay the company tax rate of 25 to 30% depending on the size, and then they can pay the director a salary or dividend at whatever rate they want. Using the $1 million as an example, they could pay the director a salary of $100,000, reducing the profit to $900,000. This director pays tax on $100,000, and then the company pays tax on $900,000. Whatever's left over is kept in the company to continue operations without that higher marginal tax rate that a sole trader would have to pay. To close off, there are additional fees associated with companies that are not applicable with sole traders. There's increased regulations around tax lodgements and accounting of companies, and it's a lot more burdensome, so it may not be the best structure for your business. Make sure you talk to your accountant and they'll be able to properly advise you on the best course of action for your business. Hopefully, I have been able to give you a better understanding of the differences between different entity types and the pros and cons and why people may choose the different entity structures. If you have any more questions, please feel free to drop a comment below and I will answer if I can. Thank you so much for watching, and I'll see you guys on the next one.